In the age of AI, there is a deeper economic question that almost nobody talks about, and it is this. It is not actually in the long-term interest of companies to create mass unemployment. In February 2026, the U.S. lost 92,000 payroll jobs, while the unemployment rate stood at 4.4%. That does not yet look like economic collapse, but look closely at this other thing buried beneath all of this. At first glance, replacing human labor with AI agents sounds like the ultimate business win. Lower costs, fewer salaries, higher margins. But if every company follows that logic at scale, the system starts to break itself. The same people companies are trying to replace are also the customers who buy their products, pay rent, service debt, and keep consumption alive. And as we know, consumption makes up for 70% of the GDP. If human labor is pushed out too aggressively, demand does not stay intact. And once demand weakens, revenue eventually follows. Now look at the labor market. We mentioned the unemployment rate stood at 4.4%. Underneath it are two moving parts, layoffs, and the rate at which new jobs are being created. And when we look at job openings, the signal is much more telling. According to the chart, U.S. job openings peaked near 12 million in 2022 and have since fallen to roughly 6.5 to 7 million, a decline of around 40% to 45% from the peak. That is a major shift. It tells us that the labor market is not simply weakening because people are being fired. It is also weakening because fewer new doors are opening. What makes this especially interesting is how closely job openings tracked the stock market for most of the last quarter century. From the early 2000s through the post-2020 rebound, the relationship was intuitive. Stronger markets, stronger growth, more hiring. In the chart, both series fall during the 2001 slowdown, both collapse in 2008 to 2009, and both plunge briefly in 2020 before rebounding sharply. The mechanism makes sense. Rising output and rising asset prices usually go hand in hand with stronger business confidence and more hiring. But since 2022, that relationship appears to have broken. Job openings rolled over hard after their 2022 peak, yet the S&P 500 continued climbing and has pushed to new highs. Over the last 25 years shown here, this kind of gap is unusual. The market kept rising, while labor demand kept cooling. U.S. GDP weakened significantly in the fourth quarter of 2025. Growth came in at just 0.7%, a sharp slowdown from the 4.4% pace recorded in the third quarter. That looks like a really steep decline. But it's not a contraction. The economy, even during the long government shutdown period, remained resilient. At the same time, personal consumption expenditures grew by 2.4% quarter over quarter. Pretty good number. PCE is the largest part of the U.S. economy, making up nearly 70% of GDP. As we know, GDP has four main components: personal consumption, government spending, investments, minus net exports. GDP growth tells us whether the economy is producing more overall, but it is still only an aggregate number. It does not tell us what is happening underneath the surface. So while 0.7% growth in Q4 2025 is clearly weak, the more important question is what exactly caused that slowdown. We've mentioned in the beginning of this video the decline in job openings since 2022, and it appears the individual parts of the GDP might be changing in proportion. Since 2009, the S&P 500 has risen by around 630%. Over that same period, real GDP has grown by only about 47%. That gap shows a massive disconnect between the real economy and the markets. What should be the case is the real economic growth along with revenues moving along with the market's valuations. This disconnect between markets and real economy is historically not normal. It clearly shows that financial markets have been expanding at a pace far above the growth of the real economy. The thing in the past 15 to 20 years was the government constantly interfering to avoid recessions. These stimuluses eventually lead not only to saving job market or growth, but they also heavily pump corporate profit margins. U.S. corporations never had it so easy like they do right now. Every chain of government stimulus, regardless to whom it's directed, eventually leads to corporations doing much better as they're the final beneficiaries of that stimulus. Looking at the longer-term picture makes the contrast even clearer. In the 1950s, 1960s, and 1970s, GDP growth was meaningfully stronger than it has been over the past 15 years. In that kind of environment, strong market growth is easier to justify because it is supported by real economic expansion. Market gains of 20% year over year are much healthier when they are accompanied by corresponding growth in GDP, revenues, and entire economic output. The result is an economy operating on multiple layers. None of the information provided should be considered financial advice or investment recommendation. Our goal is serving you the best educational content. Thanks for watching. This is Glinius.